we will have US CPI and global CPI in double figures. What does that mean for long bond yields? Double figures. What does that mean to an economy, not only a US economy, but a global economy that's highly indebted? It crashes.
Hello, everyone. Welcome to Wealthion. I'm Maggie Lake, and today I'm joined by Simon Hunt, founder of Simon Hunt Strategic Services. Hi, Simon. Thanks for being with us.
Well, thank you for having me. Though after our conversation, you may regret it.
I highly doubt that. Before we jump in, just a reminder to all of you who are listening, if you have any comments or questions, please drop them below. We'd love to hear from you. And if you want to take a fresh look at your asset allocation, after what you hear, you can get a free portfolio review from one of the advisors in the Wealthion network. Just go to wealthion.com/free. So Simon, I thought we might start just getting a little bit of a sort of set the table with what your macro outlook is. And let's start with the U.S. economy. What are you expecting from the U.S. economy for the remainder of 2025?
It's a very good question to start with. I have a non-consensus answer to that for two prime reasons. The CPI data has been manipulated ever since pre-Arthur Burns in the 1970s, so that the CPI is not 3% as it was reported to be last year, but somewhere between 9% and 10.8%.
Whoa.
9% is the figure that Larry Summers and his team, they took the methodology back to 1983 and concluded that CPI last year was 9%. Guy that I followed over the years is John Williams of Shadow Government Stats, who takes it all the way back prior to Arthur Burns, and his figure is 10.8%. Now, if you think about it, what was one of the big reasons why so many households switched from Democrats to Republicans? Because they saw it in their weekly and monthly bills. It's not 3%. And the other heavily doctored figure is the unemployment data, thanks to the birth-death model. So you create a completely false foundation for what is really America's GDP. So basically, America started entering recession in October last year, and we think that, and it's quite clear that the soft data is beginning to be seen in the hard data, and with the shocks that I think we're going to see, maybe starting next month, that it will become more generally appreciated that America's economy is not the exceptional state, but it is far weaker than is generally believed.
I think that your point that sort of ordinary folks are feeling that inflation is a lot higher than the official statistics matches up. We know that from confidence levels and from some of the surveys that they have been expressing the fact that they feel like inflation is much higher. Why are we experiencing such high inflation? Where's it coming from?
Monetary policy over the last 10 years, basically, plus food inflation. I mean, if you look at globally, I just looked up the FAO's Global Food Price Index. May on May, it's up 6%. But you have a few items up, like meat and vegetable oils up around 20%. And And I think that leaving aside what may happen with energy prices for the moment, you've got the weather patterns completely changing. And with the Gleisberg cycle likely to kick in next year, the last time we saw that was in the 1990s, which led to the Midwest Dust Bowl. So I think that inflation is going to be a primary worry, not only for households, but for policymakers. What does that mean for interest rates? What does that mean for long-term bond yields? The short end can be doctored by the Fed, but not the long end. So if you've got, which we think by late 2027, early 2028, we will have US CPI and global CPI in double figures. What does that mean for long bond yields? Double figures. What does that mean to an economy, not only a US economy, but a global economy that's highly indebted? It crashes.
When you say inflation is coming from monetary policy, can you explain that a little bit? I'm assuming you mean the extraordinary stimulus that we saw and very low interest rates.
Yeah,
But can you
yeah.
explain why you think that's driving inflation? Because
Well,
traditionally, when we see an inflation spiral, it's built into wages, but wages have been subdued, and people feel like they're not always in the driver's seat with inflation. So how is it filtering through?
well, inflation goes in cycles. If you go back to the 1970s CPI inflation pattern, it came up like that, it came down and went up. And we're in that same process at the moment. So what are wages going to do? The wages will probably have to go up higher as inflation rises. So it's a cycle. We're probably in the bottom of the cycle now. And how quickly inflation rises may well be determined by what happens in the Middle East.
How so? Oil?
Oil. Um, Iran has yet to make the decision on whether or not to close the straits. They made these preparations at least 2 years ago. The seabed has been mined with explosives, which can be triggered by a switch. And they have a couple of tankers, which they will sink in the narrow part of the channel. And I saw on a video a dress rehearsal that was done a few days ago. So before they make the decision on whether or not to shut the straits down, they have announced that any vessel passing through the straits will have to have permission to pass by the Iranian government. And I was just heard today that there are tankers lined up waiting to go through. The other thing you have to consider is probably now insurance companies won't provide insurance for vessels going through. So that's the first part. I mean, if America attacks again, which I think they will, then I'm pretty sure that Iran's retaliation will follow. And how big that retaliation will be is probably being determined today in meetings with the Iranian foreign minister and President Putin. So we'll know more in the next couple of days. But I think the odds are that there will be another American attack and ongoing after that. This is not going to be a short war. The foundations of the war are not just Israel and America's wish for or determination for regime change and almost the destruction of Iran. It also fits into the bigger picture, which is Iran is a crucial logistical hub for the east-west corridor and the north-south corridor. And on top of that, the new 10,400 kilometer railroad from Xi'an in western China into Tehran opened just a few days ago, along which Iran can export its oil and petrochemicals into China without the ability of America to close down the various choke points. And of course, China exports of whatever into Iran. So it's not just Israel and America's wish to see Iran being destroyed. It's all part of the bigger picture of America not wanting to see the BRICS group of nations maturing into an operating unit. Because if that happened, America's hegemony would disappear. So you're talking about not just a regional war, but a global one.
Yeah, I was just going to say the consequences or the stakes around the situation that you just described are so high. Let's circle back for a moment on the U.S. side, and then I want to go back to the global economy. But you mentioned, so you've got this rising geopolitical complexity and risk around that. You mentioned the weather, which we don't talk about all the time, and the potential for disruptions on food supply, pushing up food prices. In this kind of inflationary scenario, stagflationary scenario, it sounds like you're describing, is there anything, what tools does the Fed have or U.S. policymakers have to try to combat that? Do they have tools that they can use to try to address that situation?
What did they do on the onslaught of COVID?
Spend.
At some stage, they will flood the system, not just in America, but globally, or let me be more precise, in G7 countries. Central banks and governments will flood the system with liquidity. And what does that do? We know that's part of the new inflation spiral.
So
and
their
as I
policy
said
response
earlier,
will
what
make
does
it
that
worse.
mean? It is stagflation. It will be stagflation. What does that mean? It means that there comes a point when inflation is rising higher than growth. Growth will be driven by inflation, by households, instead of spending X dollars a month, it'll be X plus Y dollars a month on their necessities, which means then that the non-essential spending will be cut back. And what does it mean for corporates? Long-term interest rates rise. They see inflation rising sharply. They buy more goods, whether it be components, products, anything. Instead of holding, say, 2 weeks of stocks, it'll be 4 or 6 weeks. And in fact, there's a much bigger development that is probably only just starting. And that is with supply chains, global supply chains, being disrupted and being uncertain. Companies will be ditching just in time that optimizes capital in favor of holding additional stocks of everything in order to have their security for the supply chains. What is that going to do to inflation? And then if we're right and we do get rising energy prices, what does that do to shipping costs?
So what do you think this does for earnings?
Not my discipline.
But it sounds like you're painting a situation. Well, let me rephrase it this way. I mean, that does not sound like a good scenario for earnings. It doesn't sound like a good scenario it sounds like a scenario where, high inflation and rising interest rates, usually against that backdrop, we have rising default rates. This doesn't sound
Correct.
like a positive
No,
situation for
it's not.
equities.
No. Well, equities, you're going to have very short-term sharp rallies followed by protracted falls. I mean, to quote one example, I think we are at the moment now at a very critical inflection point, taking the S&P as an example. And that will be followed by at least a 25% fall over the summer months. Then you will have the Fed starts and all the central banks, because this will be partly due to geopolitical pressure points intensifying. So that's when, by the end of this year, central banks and governments will be starting to flood the system. So on our work, we will see markets bottoming by the early months of next year. And then you probably, over the next 18 months, you see a doubling in prices. Then you get the big fall, because 27, 28, you've got double-digit inflation, double-digit yields on long-term bonds.
Double-digit yields on long-term bonds.
Yeah. What did we see in 1980? 15%.
Is this, coming off of zero interest rates, this does not sound like a world that's set up for that type of spike in yields. So where do you think that treasuries are a viable safe haven anymore from inflation, or is that model broken?
I think you can have a short-term drop in yields because the Treasury is desperate to get yields down, as they've got $7 odd trillion to refinance. And if you refinance at 3% and not at 4.5%, that's a big difference.
Mm.
But it's only going to be a short-term rally, and then bye-bye.
If you have any questions about how to navigate the current environment, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click the link in the description below or head to wealthion.com/free. There's no obligation and it will just take a few minutes of your time. Again, that's wealthion.com/free. Thanks so much for joining us. So where do you see safe havens against that kind of world, in that kind of world, against that kind of backdrop?
I think the primary beneficiary is gold. I think that if America fails to demolish BRICS, gold will be the foundation for their new currency. At the moment, the Shanghai Gold Exchange is in the process of building gold vaults in BRICS member countries. Actually, I think the first one that is being built for other reasons is in Saudi Arabia. So the game plan is obvious that a country that is running a trade surplus with another one, the balance collateral is held in gold in the Shanghai Gold Exchange in that country. It's basically what goes on with the trade between China and Russia. As I understand it, Russia holds a very large trade surplus that's collateralized with an equivalent amount of gold held in China's central bank gold vault. The
So
difference.
the world returns to a gold standard. The BRICS world returns to some sort of gold standard.
Well, that's what BRICS is going to do. Whether America and the G7 countries follow suit is a different question. I wrote a paper about a decade ago based on something that a well-connected friend of mine, who unfortunately has passed away, tipped me off about, where he said, Simon, think about America having $2, one for domestic consumption, which will be backed by the gold that the Treasury holds, and the other will be the international dollar, which will have to find its own level. Now, whether that's part of today's game plan, I have no idea. But look, makes some sense.
So people have been warning about debt levels for a long time. Why are we hitting a tipping point now?
Because it's got to the point where you are having to issue new debt to pay old debt.
So we're just not growing quick enough. Demographics are not in our favor.
Yeah.
That's quite a difficult outlook. Is there, where do you see, outside of gold, where do you see the opportunity? It sounds like, let me rephrase that. It sounds like there are so many losers and the system is going to come under so much strain that it's hard to imagine that anyone gets out of that unscathed. So even if the sort of developed countries all collapse under the weight of this debt and the financial system, which is operating on dollars, blows up, can there be any winners? Like, can people isolate themselves? Can countries and investors isolate themselves, or does everything fall?
Well,
And
I
some
think
sort of
that
global coordinated reset, I guess, is the answer I'm asking.
households, it's best to, food prices are going to rise. So start planning for that now, not when they do rise. So to survive, you need to have you need to have surplus food in your house than you use on a daily basis. That's for households. Corporates, obviously there will be the survivors, those with very strong balance sheets. There will be a lot of failures. I think that you're going to see growth in parts of the world that have not participated in the last 10, 20 years of prosperity. I think parts of Africa are going to be very interesting opportunities. Obviously, parts of Asia. If I'm looking 10 years out, this is very non-consensus. I think the two currencies, well, over the next 5 years, the two currencies that will significantly outperform the dollar and the other G7 fiat currencies will be China's CNY and Russia's ruble.
The ruble.
Yes. You look at the chart of the ruble now, it's already turning round.
Is that predicated on Russia and Ukraine ending the war, of Russia reintegrating?
No, it's predicated on the fact that the country has very little debt. They've got large gold reserves, much larger than is reported. And they follow non-Keynesian economic policies.
What happens with commodities against that backdrop? You mentioned gold. Is it limited to gold, or do you see some broader commodity supercycle?
Yeah, I think that, first of all, the base metals always track macro developments. So if we're right that we see G7 recession until the early months of next year, then you'll see sharp falls in the base metal complex. But then from the early months of next year until 2027, early 2028, you see a doubling in the price for many of the reasons I've already outlined.
Mm.
But then you don't want to be the last guy on the dance floor, because that's when the big crash comes. So the bottom line is you've got to play these short-term cycles. Don't look for long-term investment.
Because it's too hard. Or nothing will, that larger crash you see coming in 28 will take down everything.
Yeah.
Except gold.
Except gold.
What about the role of, anytime we talk about these kinds of forecasts, and it's difficult because it's a very difficult, frightening picture that you're painting. I know most analysts try to think about what could change that scenario. What would cause me to go back to the drawing board? So how are you thinking about technology here? Is there any scenario where technology alters the course of this?
That's a very good question and a very complex one to answer. The experts that I listen to, who are normally right, think that what we're seeing with A1 now is a repetition of prior dot-com bubbles. there is obviously going to be a large usage of A1. It's the valuations that are questionable. Whereas China looks at it a different way. They've not spent the billions of dollars. They have an A1 model that's available to everybody. And what Washington fears, two things. First, China has the world's most efficient and competitive manufacturing supply chain. You can get anything within a radius of 150 miles. It's that concentrated. But the big concern in Washington and elsewhere is that China has been using robotics, automation, powered by A1 to take their manufacturing system a further stage towards even more being more competitive by putting A1 robotics, etc., onto their existing highly competitive system. There are now factories powered only by humanoids, no humans in the system, with one plant, I was told, producing a smartphone every minute. Humanoids only. So that's the first big worry for Washington. The second worry, so I hear, is that China is surpassing America on the development of new weapon systems.
Using AI. So they're going.
Who
So a scenario
knows?
where China dominates on.
Sorry,
Go ahead.
go on.
No, well, so you're painting a picture where China dominates both manufacturing and weapons using AI and surpasses. Like that's the existential threat to the
Yeah.
US.
So obviously, a primary objective, one way or another, of America is to strangle China.
So do you believe that means conflict between the US and China or just economic warfare, both?
Who
Is that
knows?
but
Who
that's a
knows?
risk.
It's
Yeah.
a risk. But what's pretty clear is that Iran, China, and Russia, they talk to each other the whole time to agree policies. And it's pretty clear that what is emerging is that Iran will stand firm over its sovereignty. Russia stands firm over Ukraine, and China stands firm on its negotiations with America on trade and tariffs.
And who has the upper hand in that standoff?
I think China, Russia, Iran. You got three guys who are going to stand firm instead of what's believed to be Washington's policy, which is to hit each one in turn. Now, China, Russia, and Iran say we will have more success if we stand as three against one.
Mm.
That's why the attack on Iran, the outcome of that is so important. It's not just regional, it's global. Because if Iran is defeated, then China and Russia know they're next.
Yeah, this is a very unsettling and very critical
Yeah.
time, especially given what you just point out. And yet we see this strange sense of, I don't know if it's a sense of calm or the market is, investors are just waiting to see what happens. But what would you leave people with in terms of either a risk or opportunity that is being underestimated by the market?
I think they're underestimating the ability of the Fed to provide its put. I think the summer months are going to be bad for equity markets. I think sometime early next year, you play the upcoming cycle, which is not a long cycle, 18, 24 months at most. So add to your gold holdings, but physical gold, not ETFs.
Why why is that distinction important? What do people need to understand about that?
Because from what I understand, even though ETFs say we're covered by physical gold, they're not. It's another leverage play.
In a very uncertain world.
Yeah.
Simon, you gave us a lot to think about. A lot of it's very disturbing, but information is power, and we all need to consider all of these options as we try to think about at least preserving our wealth, if not growing it. So thank you so much.
If anybody wants to get hold of our services, simon-hunt.com.
Fantastic. Well, we'll be sure to put a link in the description as
Thank
well.
you.
Simon, thank you so much.
Pleasure. Thanks. Sorry I left you with happy news.
It's the world we're living in, Simon.
Cheers.
If you have any questions about how to navigate the current environment, Wealthion can help connect you with a vetted advisor to get a free portfolio review. Just click the link in the description below or head to wealthion.com/free. There's no obligation and it will just take a few minutes of your time. Again, that's wealthion.com/free. Thanks so much for joining us. We'll see you again next time.